This is where you gotta push past your limits. If you don't, then your path ends here.
How's it, guys? Mr. Makhele speaking here, guys, and welcome to Makhele Traders. As you have seen by the title, today's video will be covering types of demand zones that you need to know as a forex trader. So without wasting any time, let's get to this video. So let's pay attention to the left side. We have a demand range. As we read, it says the price swiftly surges out of its previous range, breaking upwards and establishing a robust demand zone, indicating strong interest and potential for buying for further gains. So to elaborate on that point, we look at this graph. Let's look at this graph, guys. So price will create a range and then it will surge to the upside like this, breaking this range, breaking out of this range. So this zone is a potential zone for us to look for buying opportunities because price has printed the demand zone. So as soon as price comes back here, we're now interested in looking for buying opportunities. That's how the bank print demand and supplies. But this is our first demand zone. So pay attention as we cover all the demands and supply zones in this video. So in this case, let me just clarify it here. Price was in a range. It doesn't need to be perfect. Any type of range. The range can be on the M15, 1H, but it will create a range like this, and then it shoots drastically to the upside. As soon as it comes back to this zone, we now know there's high probability of price continuing to the upside, because there's a demand zone printed here. I hope it makes sense here. So let's continue. Let's look to the left. The one we're looking was called a demand range. So the second one is called a demand pivot. So a pivot, you will see, let's read here. The price makes a sharp move to the downside, but then quickly reverses course and plunges to the upside, ultimately forming a demand zone. So what is this statement saying is that price was moving sharp to the downside, but then reverses quickly to the upside, changing the course, which means now it has printed a demand zone for the banks to buy at here. So price will come and retest this zone before it continues to the upside. I hope it makes sense, guys. So the difference between these two is that on the left, the demand range, we have a range. Price will create a range before it shoots to the upside and then comes to mitigate and continues to the upside. So if we have a range, initiation, mitigation, and continuation, I hope it makes sense, guys. But on the right side, what we have a V shape like this. It's a quick in and out move, but the important thing is that it will break the previous structure like this and then retest here, then continue to the upside. Sorry for the noise, guys. Sorry for the noise. So let's continue. That's the difference between these two. On the left, we have a range. On the right, we have a V shape, but they are still both valid demand zones. Let's continue. So now we're looking the supply range, the supply pivot. As we're looking the demand, now we're looking at the supply range and the supply pivot. The supply range is the opposite of a demand level. In this case, it will create its range, failing to break the previous highs and previous low, and then it will drastically shoot to the downside. Then price will come and retest this level before it continues to sell again. So the banks have created or generated interest for them to look for selling positions at these levels again. That's a range. The most important thing here is a range, initiation, mitigation, continuation. Hope it makes sense here. So the difference between this side and this side, again, it's a V shape. But in this case, as we read here, the price makes a sharp move to the upside. But then quickly reverses course and plunges to the downside. and then it has formed what? A supply zone for the institutions to sell at. So that's our supply zone. As retail traders, we can look for selling positions using our confluences to look for entries at these levels. Hope you all understood. So as much as we have demand and supplies, we also have things called continuations and reversals. So in this video, I want to help you guys identify whether the market is in a continuation or it's in a reversal trend. So let's go. First, we'll start with the continuation. So what happens in a continuation? In a bullish trend, the market will be bullish, right? So instead of it coming back deeper after a break of structure, instead of it coming back to this demand level here, instead of it coming back exactly here, right, after a break of structure, what will price do? Price will basically do this: break the structure to the upside, and then instead of it coming here, it will print its range like this and then shoot to the upside, which means it has generated its own demand zone for price to buy at again. That's called the continuation. So coming back to the chart, let's look to the left. Price was in a bullish run, like this, and then there was a point where price started to range to the ranging. They call it this a bullish flag. Most of you know it as a bullish flag, and then price will shoot drastically to the downside. We don't take the breakout, we don't trade the breakout. Wait for price to pull back to the discounted level before price can begin to shoot to the upside. So that's called a demand range, which is a continuation. Understood? So let's go to the demand pivot of a continuation. In a bullish trend, what will happen is that price will continue its trend, right? Same thing. Instead of it coming back here, price will generate its own demand zone like this. It will be a V shape like this, break the structure. It has generated its demand zone for it to continue buying. These types of continuations, you usually see them on what? Gold, USDT, and Nasdaq. On currency pairs, it happens, but I will say 10% of the times, not like every time. So it's mostly effective on gold, USDT, and Nasdaq. So these were demand continuations. Let's look at the bearish continuations. So this bearish continuations of a supply level, it's like this. Price was in a bearish trend, as you can all see, and then it reached a certain level where it ranged by it failing to break the previous highs and previous lows. And then there is a time where price will shoot to the downside. After shooting to the downside, price will come back and mitigate this level. We call it a pullback. Price will pull back to this level and then it sells again. So as traders, we try to look for these selling positions here. Don't trade the breakout. Wait for price to come and retest the level before you take an entry. Because sometimes you may find out that your entry is here and your stop loss is precisely where price will reverse at. You're correct about the direction, but your entry was very wrong because of your impatience. So before I even forget, guys, we do have a Telegram channel where we post up our analysis, markups, and news events. So if you feel like you are interested in learning more, do check the link down in the description below. Let's continue. The supply pivot. The supply pivot is the opposite of a bullish pivot like this. But these are continuations. Don't forget, guys. We're covering continuations. So in this case, price is continuing to the downside. Instead of it coming to mitigate at the supply level like this, it will print its own minor supply zone here and then break the structure. Do you see the difference? Price never came there. It just generated its own supply zones to continue. So we have an unmitigated supply zone there because price has generated its own supply zone here. It happens most of the time thinking that price will come back deeper here, only to find out price has generated its own supply zone here for continuation, for price to continue selling. That's called continuations. We're done with continuations now. Let's go to the reversals. How do we spot market reversals? Let's begin. So in this case, how do we see a demand zone being generated in a bearish trend? I hope it makes sense. How do we see a demand zone printed in a bearish trend? So if we look to the left, let me just annotate here. Price was in a bullish trend, was in a bearish trend, sorry. Bearish trend like this. Then there's a zone where price will generate a range like this. To start ranging. Sometimes they do sweep liquidity to the downside before it shoots to the upside. It depends on price, what it does on that time. But here, it will range. After ranging, shoot to the upside. It has now generated a demand zone. But not just any demand zone. That demand zone must have a gap, which we call imbalance. Because if there's a gap, there's high probability of price wanting to gravitate back at this demand zone before it shoots to the upside. Price is trying to cover this imbalance. So in a bearish trend, price will print a range like this, shoot to the upside. Then we now know there's a zone that price might come back at before shooting to the upside. That's a reversal. That's a reversal for you guys. So let's look at, that's a reversal, but it's a demand range reversal. Then we have this second example, which is called a pivot range reversal, which is a demand zone. So price was in a bearish trend, as you can all see, like this. Then out of the blue, price breaks the previous high like this. This previous high was taken out. So we call this a change of character. So that's our first signal for price that price might be what? Bullish. So after giving us a change of character like this, price will come back to this level before shooting to the upside. So that's called a pivot. Why is it a pivot? It has no range. It has not created many candlesticks. It has just created what? A V-shape reaction. As you can all see, that's a V-shape for you guys. Yes, let's continue. Those are demand reversals. So let's see supply reversals. I hope you all understand the reversal. A reversal is basically when the price was bullish, then it starts to print an opposite trend. As we can see on the left, price was in a bullish trend here. And then it reached a certain level where price started ranging, and then shot drastically to the downside, which we have a break of structure to the downside or a change of character. And now we know that price might come back and mitigate this supply level. And price, after mitigating this zone, it tends to what? Continue dropping to the downside because it has printed what? A reversal pattern or price action, if you want to call it like that. So let's continue. The pivot example, it's a V-shape, guys. Don't forget that it's a V-shape. The difference between these two, it's a V-shape. This one is a range, this one is a V shape. So the trend was bullish here. Then there's a level where price now will disrespect the structure, giving us a change of character. This whole zone is our entry or our zone for us to look for selling positions, depending on what time frame you use to enter your trades. So as we have covered these demands and supplies, we have covered how the demand zone is created and supply zones. We have covered types of continuations of a demand and supply. We have covered what reversals, how does the market reverse trends here using demands and supplies. So now let me just give you an example. How does it look using candlesticks? So this is how will the market look on a range. This is an example of a range on candlestick. So there's a lot of candlestick failing to break the previous highs and previous low, which means price will be just trading within these highs and lows, and then it will shoot to the downside. This zone, it's our now so-called supply level. That's how a range is formed. But if we look for a pivot, it might not be a lot of candlestick. You might find out it might be like the bullish candlestick going up to like this 2 or 1, then price shoots to the downside. That's a V shape for you guys. You see? Yes. So that's a V shape. That's the difference between a range and a pivot. A pivot is just less than 2 candlestick, but a range, you can find out it has more than 5 candlestick within the same high and low. Within the same high and low. That's why we call it a range or a consolidation. Yes. So how do we then apply these reversals and continuations using a real chart? So let me just explain here before I close the video. So here, if you look at, I'm using a bullish example. If you look to the left, we have a break of structure here. We have a break of structure here. So the trend is bullish. So what we understand at Makhele Traders is that every time price break the structure, we expect a swing pullback to a demand zone before price continue its bullish trend. But in this case, what's the difference is that? The difference is that price will break structure to the upside like this. Instead of it coming back now at this demand zone, it will print a range. It will generate a range here, guys. Generate a range and then shoot to the upside like this, which means it has printed a new demand level for price to buy at before it continues. That's the difference here. It's called a continuation, a bullish continuation. Mostly you find this one called USD and Nasdaq, as I have said, guys. So in this case, let's look at the chart here. So price is bullish like this, break structure to the left, then instead of it coming back now, it prints its own demand zone like this, breaks out to the demand zone, retest, and then continues. If we see this pattern and you believe that price might continue to the upside, it is valid to look for continuations to take these entries. But you must be aware that price is what? It's highly priced. It's very highly priced. It might reverse at any time, you see. So you must be very aware of that. So this is the bullish continuation, as I have written here. It's called the bullish continuation. That's how it's printed. Then let's look to the left how a bearish continuation is printed. So in this case, since we have an unmitigated demand level, price has to come back to this zone before going back higher, before trading higher. It has to mitigate this demand zone because there's some orders the banks have left here that needs to be filled. So for price to come back there, what will price do? So price will shift in a bearish trend like this. Instead of it coming back here because it wants to complete its objective by mitigating this demand zone, it has to what? Print new fresh supply zones, which we call bearish continuations. Most of you call it bearish flags, but this is called the bearish continuation. So here price, the banks will print a supply level, then we'll see a drastic shoot to the downside of price, and then price has to come back and mitigate this level. Then we can look for selling positions here, guys. We can look for selling positions before prices to come and mitigate this demand zone. So the last one, in terms of, I've covered continuations here. So let me just show you the last one, which is a reversal. So pay attention here. So price, as you can see, it was bullish. But after this break of structure here, this minor break of structure, price will give us a change of character, a shift in structure like this, which is called a change of character, guys. So after a change of character, we now know price has generated a supply zone somewhere around here. So we can look for entries to take to play this pullback to this demand zone before price continues to the upside. So we can look for selling positions here. Here. That's it for today, guys. Those are the types of demands and supplies that you need to know. Continuations, and reversals as well. We have a demand range, we have a supply range, we have a pivot demand, we have a pivot supply. Just rewatch the video if you don't understand or you feel confused. But thank you for today, guys. And for more content like this, just subscribe so that we know that you like this content. Thank you, guys. Sharp, sharp.